blah 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 due to a technical problem of another railway company. Never heard of it. By the way, it was 25 minutes late, the train, and so there was no alternative. It's the first time, by the way, I must say, we did that. Well, probably because it was coming from Napoli, this train. So, you know. So, I'm sorry for that. But I have good news for you. The good news is that, I don't know if it is good news. Apparently, it seems to be good news. In case you think it's exactly the opposite, there is one responsible for that. Again, it's not myself, it's this lady over there. We have prepared a written exam exactly for pandemic, exactly the same format, the same standard as the previous one. Okay? As requested by the trade union representative here. So it's going to be 40 minutes, 20 questions. Okay? Right. Guys, we have half an hour before the lunch. So it was just to say hello to all of you. How are you today? How do you feel? It's a beautiful weather. What we have to do today is basically two things. The first one, we have to examine the second set of slides. Okay? Tutto bene? Okay. The second set of slides, which is the working out details. And secondly, we need to prepare and discuss the Diageo case, that is a case on the first set of slides. Okay? As I told you, you will have this amazing and unique opportunity, so you are privileged people of sharing the presentation with Niccolò Nirino. I will be here as well, but let's see what we can do. So I don't want to raise the expectations. Huh? He has prepared some slides, some questions, so he has worked intensively, and it is correct, fair, that he also has this opportunity of presenting in English this important case. But there is something that he wants to say.
We have also good news about the take exam on Monday. There will be
ma non era qua quando l'ha detto.
Grazie ragazzi.
Sta difesa d'ufficio. Okay, so do you have questions concerning what we've seen so far? Everything is clear? Are you sure? It's not because you're shy, you don't want to ask? Okay, so let's go straight to the second set of slides, which is this one. I've slightly modified a couple of them, but formal things last night, this morning at 5 a.m. Because as I was telling them, I woke up at 4:42. I remember perfectly because I was woken up by my little boy saying, "Ho fatto la pipì a letto." Bravo. For an applause. And then yes, I stayed up basically. So working out the details, I woke up at 4:42 to arrive late. This is really twisted. So, what is the issue now? The issue is the following. We have learned yesterday and 2 days ago how companies should set their mix of debt and equity. More specifically, we have learned by using the trade-off model that there is somehow, somewhere, an optimal capital structure corresponding to the kind of values of the debt-equity ratio that minimize the cost of capital. You want me to show again the graph? It's the usual good old graph of the U-shaped curve that has a minimum point. Now the problem is, and this basically deals with the first sentence that we have here. The manager must decide the desired mix of debt and equity, parentheses, not unwritten here, but in our mind, using the trade-off model, for example, or the pecking order model. Then we have step number 2 and step number 3 of financial decisions that concern, I wouldn't say the daily business of a firm, but almost. The second important kind of decision that the financial management of a firm must take concerns to decide if it's a big if, and how to reach this optimal level in the U-shaped curve. Actually, I've mentioned that yesterday, we have commented that yesterday, just to introduce the topic of today, that if we go back, by the way, if we have a U-shaped curve and we are not currently positioned on the left of the optimal level, we are under leveraged. If our current position is on the right of the minimum level, we are over leveraged. Okay? In any case, according to the trade-off model, we are in a suboptimal position. Okay? If we are in suboptimal decision, there's one question that we should address to ourselves, which is, shall we care about the fact that we are far from the optimal position or not? Or we can stay where we are because we prefer staying there. So the if that you see over there, if in the parentheses, relates to the fact that some companies may deliberately decide not to move or to change the capital structure from what it is now. And we have seen also that probably the easiest and the most popular, the most frequent suboptimal situations where there are some companies that deliberately decide not to have any debt at all. Remember that, and this is something that we can explain. This behavior can be explained using the pecking order model, but it cannot be explained using the trade-off model. Okay, that's the idea. So suppose that we decide to move from where we are, the suboptimal position, toward the optimal position. Okay, so suppose that we solve the puzzle of the if positively, saying we want to move from where we are, assuming that we are in a suboptimal position, to the optimal one. Okay, if that's the case, you see the arrow. The arrow is one of the news that I've introduced this early morning. Okay? The arrow immediately brings us to the second step of decision that in turn involves, okay, I am here. My optimal position is here. Okay, if you think about it, and I want to move from where I am to where I should be, well, actually, I have a couple of related decisions that I must take, which is how do I get there, and how fast I want to get there. Okay, so these are two elements of decision that, needless to say, enrich the spectrum of the financial decisions that the financial manager must take. Third, let's go upward again. Third, once we have decided that we want to move from where we are to the optimal level, we have already decided about the speed with which we want to go and the alternative method that we want to use to reach the optimal level. The third and final decision on which we're going to make some comments, I would say at this point, immediately after lunch, is, okay, now that we have taken all these decisions, let's take a final one. And the final one is, what about the debt component of the firm? What kind of characteristics we do expect or we do believe that to be more useful and more appropriate for our company? And we see that this refers to the maturity, the basis, and the currency that we use for financing ourselves. Okay, so This slide here summarizes what we're going to see from now on. It's a sort of an agenda of the day, agenda of the set of slides. Okay? Let's start with the alternative methods. In other words, we are now in step number 2, because step number 1 was the previous days. Step number 1, see set of slides number 1. Point number 2, suppose that we decided to change our position, the 2 decisions that we must take relate to speed and methodology of convergence toward the optimal point. And the slide, in these incredible colors that I have decided to use, I hate green in general. I don't know why I'm using green, but by the way, different degrees of green, which is even worse. This slide summarizes the methodology, alternative methods of to change the density ratio. Okay, so this slide should be commented in detail because it tells us everything. I mean, some suggestions about what are the alternative methodologies, the first column, and the speed that characterizes each of them, the third column. Okay, let me explain you what we're talking about, hoping that we can comment at least this line before the break. Otherwise, we're gonna conclude it. But I think we can do it. We will do it. Actually. Methodology number 1. Methodology number 1 is not in terms of importance, according to the table. A recapitalization. Probably this is the most intuitive methodology that we could use in order to shift our position to a new level. This means, depends on where we are. If you are on the left or the right of the optimum point, right? That's obvious, okay? So, if we could use new equity to retire debt. It means that we will be less levered, okay? Less levered. And this possibility relates to the situation in which we are on the right of the optimum point. If we are excessively leveraged, one thing that we could do is to issue new equity and use the proceeds from the capital increase to repay a portion of the debt. What's going to happen in our graph? It's going to happen that we move from the right side of the graph toward the center of the graph, okay, to a lower leverage. Alternatively, we could issue new debt to buy back equity. Okay, I'm commenting here. New debt to buy back equity if we are on the left of the graph and we want to move toward the center. Because by issuing new debt, we increase the leverage of the firm, so it means we move toward the right of the graph by definition. And it's even worse, it's even more aggressive, this methodology, if we use the new debt, the cash inflow from the new borrowing, to repay some of the existing shareholders. Because by doing so, you're borrowing new debt, which means that you're increasing the numerator, the D. And you use that increase of the numerator to further reduce the denominator, which means that you have a double effect, in other words. And in fact, this double effect also highlights the fact that this methodology is a rather rapid way for moving from where you are to the optimal level. It's not a gradual, progressive, slow way of doing things. It's a rather aggressive one, or if you prefer, it's a rather rapid one, fast one, okay? A couple of additional caveats. The first one concerning this specific methodology. The first one is that capital increase may reduce the stock price. Why? Because there is a dilution of the value of the shares. Because normally when you want to increase, this is something that we have not, it's beyond the scope of this course, but so trust me when I say, for at least once, when I say that when a company, especially if it is listed, it announces a capital increase, normally the stock market reaction tends to be negative. Which is another conundrum, by the way, in finance, because you wouldn't expect this kind of reaction by the stock market. Let me tell you, because this is intriguing. I mean, you know that I know these things, so for me it's intriguing, for you it could be totally boring. But in any case, the idea is this the following. If we go back to you remember what is the Alex? Non c'è.
It's coming later, after the lunch.
Hi Al Capone, everything is okay today? It's coming after lunch. Okay. By the way, if you remember, Alex yesterday suggested the signaling effect, that we commented extensively. The fact that an announcement of a capital increase frequently turns out to be negative in terms of the stock price dynamics relates to the signaling effect. Think about it. Why do we have let's put it this way. If a company announces an increase of capital, we would be tempted to say that this is good news. Because the company is reinforcing itself. It's not borrowing new money. It's not becoming risky. It's becoming less risky. Why? Because there's an additional injection of capital in the firm that presumably, it's an oxygen mask, right? However, notwithstanding these intuition that we may have, as I told you, the market normally, not always, but normally reacts negatively. How come? Why? Because of the signal that the market reads between the lines behind the capital increase. The idea is the following. This is something that Al Capone can perfectly understand. When are you dear company, tempted to issue new shares? If you are listed on the stock market? Sorry?
When you need capital.
When you?
Need the capital.
Okay, that's a monte, but if you are a listed firm, this is important. If you are a listed firm, when are you more incentivized to issue the shares? When you believe that your shares are overvalued by the market, because you want to make a good deal, right? If you know that, think about it. When you increase the capital, you are selling something on the market. Selling what? New shares, new pieces of paper, right? You are the seller, you are the company, you are selling something, like in a market, right? When do you think I will be more, incentivized to sell this paper to you? When I know that I'm making a good deal. And making a good deal for me as a company means that you're going to pay a very high price for this piece of paper, which means that I believe that these shares are overvalued. You subscribe them, peggio per te. But that's good news for me, bad news for you, right? Let's put it the other way around. Suppose that I am the company, and I believe that the market is penalizing me because the share price is lower than the fair value. Would I be tempted to sell new shares? No, intuitively. So no. Why should I sell the new shares if they are the price? It means that I'm applying a non-requested discount to them. To them it means to the new shareholders. While conversely, if they are overpriced because the market is irrational, because the market is excessively optimistic about my firm, because of various reasons, because there is euphoria on the market, and all the companies, all the stock prices go up. That's the right moment for me to sell the new shares. But the market is not stupid, and it discounts in this announcement of a capital increase the fact that probably the shares are overvalued. So it reacts negatively in order to bring the share price to a lower level. Okay? This long explanation relates to the first sentence on the top right section of your table. Capital increase may reduce the stock price. This is the explanation for that. And a buyback, second caveat, the buyback may damage creditors this is something that I think, I believe we have already, although rapidly commented yesterday. When you buy back some of the shares, Professor Almeida, I'm sure will go back on this point. You buy back some of these shares, it means that you are extracting cash from the company. You're buying something, you're giving your cash in exchange for something, right? And this is an action that normally creditors don't like to observe. Why? Because the more you reduce the cash on hand available in the company, the more you may put in a serious dangerous position, the expectations of financial creditors. Okay? So these are the two major caveats that relate to the recap. But what you need to remember is that this is a methodology that is relatively popular, okay? And it's a rather, if I may say, aggressive one. Aggressive means that it changes the position of the firm quite rapidly. Quite rapidly. Second possibility, this table is a sort of a toolbox, okay? A toolbox that the company has in order, and from which it can pick the appropriate tools in order to reach the objective of moving from where it is to where it would like to be. Second tool, if you go in the toolbox, there's another box. So that's the second one, divestiture. An alternative could be a divestiture. What do we mean with divestiture? Divesting means selling some of the long-term assets that the company has. To sell these assets in order to do what? To collect the cash from the sale and to use this cash, as the slide says, to pay off the debt or to reduce equity according to your needs. It depends if you are on the left or if you are on the right. Needless to say, especially if the asset that you are considering selling is a rather big one, a building, a plant, or whatever, so the cash that you're cashing in is going to be rather important. The amount of money that you can use in order to repay the debt or to reduce equity could be substantial, and thus the speed of movement from where you are to the optimal level could be, even in this case, quite rapid. The caveat here relates to the fact that, as you know, it takes two to tango, which means that you may be willing to sell some of the assets, but you need to find a counterparty which is interested in buying an asset. That's obvious. And secondly, which is the first thing mentioned here on the table, when we consider these alternatives, the divestiture, we normally consider it for non-operational assets. Well, you remember the attività accessoria from Italian, so it's all complementary, which means the assets for which the company can get rid of without hampering its survival and or its normal operational ability to carry on the business. Okay? That was number 2. Number 3, sale and leaseback. Have you ever heard about this technique, sale and leaseback? You should. So it's time to become familiar with this possibility, because it's a rather, I wouldn't say popular, but it can happen in your professional life. Sale and leaseback, as the description says, means, well, actually, even the definition, sale and leaseback, it means that you sell some of the assets that you have to a leasing company, which becomes the owner of the asset. Then, in turn, will allow you to lease that same building or asset or whatever from the leasing company. Francesca corruccia le sopracciglia. What the hell is that, right? Sempre strano. What is the major objective that companies that go for a sale and leaseback want to achieve? The fact that you need that. So let's suppose it's a building. Okay? You need that building because, for example, in that building you have the headquarters, the offices, the central offices, okay? But you also need money. You need a building, but you need money. What you can do is to sell the building to a leasing company with the promise, contractual agreement, it's not a promise, with the agreement that you will rent it, you will sell, you will lease it, actually it's more appropriate, you will lease it from the leasing company. So you get a lot of money now for having sold the building, in exchange for which you pay an annual installment, the leasing installment, okay? A lot of companies which are serious problems frequently have done this, because as you may imagine, there are some assets that for you it is not important to have the control, the ownership. It's important for you to use them, but not to own them. If that's the case, you can sell the asset and rent it from the leasing firm. The advantage is that you get relatively a high amount of money when you sell it, in exchange for which you need to already forecast that each year, or each 6 months, whatever it is, periodically you have an installment, a lease installment that you must pay. Which, by the way, it has also an additional advantage, is tax deductible. The lease installment. Buttalo via. No? This one concerns operating asset, as I told you, the example, the classical one is the example of the headquarters. Because the headquarters of some companies are located in historical centers, city centers, very beautiful buildings, come si chiamano, top buildings, trophy assets, they're called trophy assets, that if you sell them, you could get a lot of money, okay? They're called trophy assets. Do you mind if you go ahead? Yeah, well, we must. I mean, we need to finish at 1 o'clock, okay? Because since I arrived late, I need to somehow recover a little bit. Fourth alternative. Oh, sorry, I forgot to say that even the third one is a rapid one. But now you understand, no? You sell, you get a lot of money, you can use immediately that money for changing rapidly your situation. Number 4, different mix of financing for new investments. Now we're going toward the most calm methodology for moving toward the optimal level. And it is also probably the most popular technique, formally or informally adopted by companies. Okay? What do I refer to is that I know that I am here, suppose, and I know that I want to go here. I have 3 alternatives that rapidly can bring me where I want. Okay, so a possibility. Or I could decide to move slowly, progressively, toward the optimal level. Suppose that I am on the left of the optimal level. It means that I am under leverage. Okay? What I can do in order to move progressively toward the optimal level is, whenever I have to finance a new investment from now on, I will ask the money to banks. Which means that I will put in my debt amount additional incremental amounts of debt that progressively will increase the debt equity ratio. You understand what I mean? You do it progressively. You know that you want to have more debt in your capital structure. So you say, okay, from now on, whenever we need to raise money for financing our activity, we will borrow money. That's simply what I'm saying. Okay. It's about progressive approach. Okay, and you can work also the other way around if you're on the right and you want to move toward the optimal level. Okay. Fifth and final alternative. You can also use the dividend policy to change your debt equity ratio. This can be explained in 2 ways, actually. Let me write in order to avoid any kind of misunderstanding. Let me see if I remember what I should do in order to write. First, I need to switch on. Second, I need to interrupt the. Okay. Video. Voilà. Interrompi, non interrompi. Basta proprio. Esatto. Giusto? No? Cos'è? At home?
Yes.
Sì, sì, vediamo.
Grazie. Okay. What I'm commenting now is that, let me use the pen, the fact that we can change our debt equity ratio. Okay. Non è a fuoco, aspettate, no. Calma. Autotune? No. Hai autotune? No. Menu?
Yes, okay.
Sì. Ah, si legge
Sì.
poco, si legge poco. Facciamo con questo. No, questo è il blu, mi piaceva, non va di moda. Facciamo il rosso, poi ben, nero non c'è. Facciamo bene, no, il verde non mi piace, rosso. Facciamo rosso alla fine. I, su, e. Oddio, non è che sia proprio il maschio. This way. The over E. We can change this D over E also by changing the dividends, and this is less intuitive. Irina is smiling, I don't know why. Why are you smiling? I will convince you. Dividends means cash, distributing cash. In a lot of circumstances, but what I'm telling you now can be relaxed and the conclusion won't change, and I will tell you why. Rather than D, a lot of companies use ND. When ND is over E, ND stands for net debt divided by equity. Where net debt means total debt minus, that's where the word net comes from, minus cash. Divided by E. So if that's the case, by changing the dividends, I change the cash and I change the debt equity ratio. The higher the amount of cash that I distribute with ordinary dividends or extraordinary dividends or shares buyback, these are the three cash possibilities for distributing dividends. Whenever I increase this cash distribution, the debt equity ratio goes down, and presumably I will move from the right toward the left. Or the other way around. If I have a lot, if I've been used to distribute a lot of cash in the past, I could change the policy and become more stingy in terms of the amount of dividends that I distribute, which means that the cash that I distribute is going to be lower. If it's going to be lower, the ratio would be in the future higher. Okay, it will be higher, and you can move from the left toward the optimum. Okay? I told you that this this very simple rationale works also if you stay with D over E rather than ND over E, because you may correctly argue that even if we consider D here, total debt here, not net debt, cash actually enters here, because if you, I wanted to use a parola italiana, depauperare, if you let your company become poorer by distributing cash, the value of equity will go down, which is exactly the same result that you get here. Okay? What are the caveats for this final alternative? Pay attention, because especially if you're a listed firm, the dividend policy is rather sticky. In other words, it cannot be that hectic and change from one year to the other, because the market will not appreciate a total craziness of the dividends distribution. Okay? These are 5. There could be others. There could be other alternatives. These are the 5 that are reported in your slide, the 5 methodologies for moving toward the optimal level of debt. Now, it's 1 o'clock. After the break, at 2 o'clock, we're going to come back here and focus our attention on the third and final step of our analysis, which is, let's enter into the box of debt. What kind of debt should a company have? Enjoy the lunch.
Andiamo a mangiare.
Ci siamo stancati. Meritiamo andare a mangiare.
Irino, andiamo a mangiare.
Hi.